So what happens when you take a highly efficient, perfectly legal money printing machine, one that just sits there quietly churning out cash week after week, and you forcibly bolt it to a bleeding, highly volatile, ultra-luxury car dealership on the other side of the planet?
You get a very stressed out management team, probably.
Right, exactly. Today, we are looking at basically the ultimate corporate odd couple. Welcome back to the deep dive, everyone.
Glad to be here.
So our mission today is to unpack Sports Toto Barad's Q4 2026 and their full-year financial report. We really want to figure out what is actually going on under the hood of this incredibly strange hybrid business.
Yeah, it's one of the most fascinating structural tensions in the market right now, because you have assets that are super defensive and predictable, almost like a utility company chained to assets that are, hypersensitive to global macroeconomics.
It's wild. And for you listening, this is actually a highly anticipated follow-up for us. A few months ago, in our Q2 2026 deep dive, you can find that on YouTube. The idea is 52CRZGU_YQE. We were tracking this exact dynamic.
Yeah, we were watching a lot of moving parts back then.
Right. We noted they raised their dividend. We were tracking the structural drag of that UK car dealership, HR Owen, and we flagged this massive looming court risk for their retail outlets in the state of Kedah. So today we have the updates on literally all of those fronts.
There's a lot to cover.
It is. We're basically answering the ultimate question.
Yeah.
What happened next? And is this stock still a reliable dividend machine for your portfolio?
Well, but just to set the baseline here for anyone new, Sports Toto, or SPToto, operates in two completely different universes. In Malaysia, you have STM Lottery. That's a highly protected, cash-generative, legal lottery oligopoly.
Oh, cash cow.
Right, the cash cow. Then over in the UK, you have HR Owen. That's a luxury automotive segment that requires staggering amounts of capital just to, keep the lights on and the inventory stocked.
Okay, let's unpack this. Because before we look at the whole cash fire happening in the UK, we really need to look at the engine paying for everything, which is that lottery segment in Malaysia.
Makes sense.
So let's dig into the full year FY26 numbers. Because honestly, on the surface, they look surprisingly bruised for a business that is supposed to be so defensive.
Yeah, they do.
I mean, group revenue dropped 6.8% year over year to RM 6.03 billion. And the profit before tax took a really serious hit, dropping almost 18.3% down to RM 303.3 million.
Yeah.
So if this is a utility like cash cow, why the massive drop?
So we have to look at the math behind consumer psychology here.
Yeah.
In the lottery business, there's this phenomenon known as the luck factor.
A luck factor.
Yeah, and it specifically revolves around jackpot cycles. So in the previous year, in FY25, SPToto experienced a massive statistical anomaly. Their supreme Toto 658 jackpot just kept rolling over repeatedly until it hit this record-breaking RM 121.7 million.
Oh, wow. Right, and when a prize pool gets that astronomically high, it transcends just the regular daily players.
Yep.
You get office pools forming. People who have literally never bought a ticket in their lives suddenly want to be multimillionaires, and your sales volume just goes through the roof.
That's the frenzy effect. But in FY26, the law of large numbers kind of took over. The jackpots normalized. The prize pools were much smaller on average, which, naturally led to a dip in those frenzied casual ticket sales.
It makes total sense.
And on top of that, they actually conducted one less draw in FY26 compared to FY25. So they had 163 draws versus 164.
Just one less day of operations.
Yeah, but when you combine smaller average jackpots with one less day of operations, you get a 5.3% revenue drop for the lottery segment on a full year basis.
So it essentially operates like a casino.
Pretty much.
Like the house always wins in the end. But sometimes the players hit a lucky streak, or in this case, the jackpot just gets claimed early before the hype can build up and your margins shrink for a while.
Right, but the math always corrects itself. And we actually saw that correction happen dramatically as the fiscal year closed out. So despite the full year drop we just talked about, the Q4 2026 results were this fascinating plot twist.
Oh.
Yeah, in the fourth quarter alone, profit before tax actually surged by 33.7% year on year to RM 96.6 million.
Wait, really? A 34% jump in a single quarter is a massive swing.
It is, and it was driven entirely by a normalization of the prize payout ratio, basically the luck factor swinging back in the operator's favor alongside heavily reduced operating expenses.
Okay.
So the core Malaysian lottery engine is actually recovering beautifully. It's showing incredible structural strength as they exit the fiscal year.
But wait, if the core business stabilized and actually surged in Q4, why is the overall group profit still being dragged down so heavily?
Right, and that brings us straight back to the secondary business, HR Owen in the UK.
The bleeding car dealership.
Exactly. The bleeding there has not stopped. In fact, it's gotten worse. HR Owen went from generating a profit in FY25 to posting a pre-tax loss of RM 26.3 million for the full FY26 year.
The 26 million ringgit. That is just a massive anchor for the lottery business to drag around.
It is. And to put it in perspective, even in Q4, that same quarter where the lottery business was soaring, HR Owen still reported a RM 1.6 million profit and loss. For context, in the exact same quarter last year, that dealership made an RM 11.7 million profit.
Oh, man.
Yeah, it is a severe contraction.
I really struggle to understand this because luxury buyers are usually immune to inflation, right? Like, if you have the capital to drop £1 million equivalent on a Bentley or a Ferrari, an extra couple of percentage points on a UK interest rate shouldn't stop you from buying the car. So why is HR Owen suddenly a cash incinerator?
See, that is a very common misconception. The primary threat of high interest rates to a luxury dealership isn't consumer financing. It's actually the dealer's own financing.
Oh, interesting.
Yeah, it all comes down to floor plan financing or vehicle stocking loans. When HR Owen brings a fleet of multi-million-pound supercars onto their showroom floor, they don't buy them outright with cash. They finance that inventory.
Ah, of course. So they're borrowing money just to let the car sit there until a buyer walks in.
Exactly. And when you're carrying tens of millions of pounds in supercar inventory, prolonged high interest rates in the UK turn into this ticking time bomb. Every single week a car sits unsold, the debt holding costs just eat away at the eventual profit margin of the sale.
They are literally racing against the clock the second a vehicle is delivered.
Yeah, they really are. Add to that the fact that UK inflation has driven up statutory employment costs, meaning new labor regulations are forcing them to pay their staff significantly more.
Right.
And then you also have the issue of transition models. Well, several major luxury manufacturers are currently phasing out older vehicles to make way for new hybrid or next-gen lineups. So HRON is stuck with an oversupply of these older transition models, and they just don't command peak pricing. They have to discount them just to move the metal.
Jeez. So they're paying higher interest to hold cars that they ultimately have to sell for less money.
Yep.
And then, I imagine, when you translate those struggling UK pounds back into ring for the earnings report, it gets even worse.
Oh, the foreign exchange effect has been brutal. The ringgit has strengthened against the pound, which makes those UK losses look even more severe on the group's consolidated balance sheet. It's just a perfect storm of macroeconomic headwinds.
So if I am an investor looking for a reliable dividend yield, I really have to ask, why on earth doesn't SPToto just sell this car dealership?
I know, right?
I mean, why hold on to a non-core liability that is visibly draining the profits of a perfectly good lottery business? It just seems like corporate malpractice to keep funding a leaky bucket.
Well, analysts ask management that exact same question on almost every earnings call.
I bet.
But the strategic defense for keeping HR Owen relies on a medium to long-term transition plan. Management isn't just taking the hits passively. They've actually invested massive capital expenditure into a brand new 110,000 square foot bespoke supercar complex in Hatfield.
110,000 square feet. That's not a dealership. That's a luxury compound.
It really is. It houses 4 different luxury brand showrooms, major event spaces, and most importantly, massive after-sales service centers. Because the strategy here is a pivot. They want to transition HR Owen away from just being a low-margin vehicle seller that gets crushed by interest rates and turn it into a high-margin, surgeon-led model.
Right.
The real consistent money in luxury automotive isn't in selling the car once. It's in the incredibly expensive, specialized maintenance required to keep those machines running over the next decade.
Okay, I see the logic. But right now, today, that Hatfield complex is just burning through capital allocation.
Yeah.
Which means the lottery segment back in Malaysia has to work overtime to fund everything, including the company's famous Dividend.
Yes, it does.
And here's where it gets really interesting, because despite the overall profit drop, and despite HR Owen losing RM 26.3 million, SPToto actually raised its full-year dividend.
They did. They bumped the dividend up to 11.0 sen per share for FY26, which is a really noticeable increase from the 8.0 sen they paid out in FY25.
But if profits are contracting and they're funding a massive luxury compound in the UK, How are they affording a dividend hike? Like, where is that cash actually coming from?
It's coming directly out of their cash reserves. Maintaining and raising this dividend pushed their payout ratio to a staggering 76.8% of earnings.
Wow.
Yeah, they are essentially squeezing their own liquidity to ensure income investors stay happy during an earnings contraction.
That feels like a highly defensive move. Like they know investors hold the stock for the yield, so they're terrified of cutting it. But paying out nearly 77% of your profits leaves very little financial flexibility if something else goes wrong.
It really doesn't.
So does that crack their financial moat? Let's pull up our financial moat scorecard here. For those who joined us in our previous deep dives, we gave SPToto an overall financial moat score of 6 out of 10. Does that hold up under this new report?
Well, looking at the FY26 audit, the score remains exactly 6 out of 10. We grade their capital distribution moat as a fantastic 8 out of 10, largely because of their sheer resilience in defending that dividend payout for shareholders, even when times are really tough.
Right.
And the core cash moat of the lottery business is still a solid 7 out of 10, but their capital allocation remains a very poor 3 out of 10, entirely because of the continued cash burn and management distraction at HR Owen.
Got it. And what about their competitive moat? We previously rated their actual market dominance against rivals as a critically low 4 out of 10.
Yeah, that score remains a 4 out of 10, and it is entirely due to the RM9 billion shadow in the room.
9 billion ringgit. That is just a breathtaking amount of money leaking out of the legal system.
It really is. Analysts estimate the illegal gaming shadow market in Malaysia is roughly 2 to 3 times the size of the entire legal market.
That's insane.
And the structural problem is agility. Unregulated operators are just incredibly nimble. They use encrypted mobile apps, they accept cryptocurrency, they don't have a corporate tax burden, and because of that, they can offer much higher payout odds to the players.
And obviously, I just want to be clear for the listener, we're not taking any political sides here. We're just looking at the facts of the business landscape.
Yeah.
And the reality is, meanwhile, the legal number forecast operators, the NFOs like SPToto, are strictly prohibited by regulators from selling tickets online or via mobile apps.
Right, so the legal operators are forced into a very rigid box. They have to maintain expensive physical storefronts, pay staff, print paper tickets, and pay heavy gaming taxes.
It's like watching a ground war against an air force. Like, the legal operators are stuck fighting trench by trench with paper tickets and physical storefronts, while the black market is running a massive, highly efficient digital air campaign above their heads. They're fighting with one hand tied behind their back.
That is the perfect analogy. It is a severe structural disadvantage. The regulatory limitations on digital sales act as a hard cap on the legal operators' growth, and the illegal channels simply rush in to fill the void,
Yeah.
siphoning massive amounts of potential tax revenue out of the public system in the process.
But speaking of that physical ground war, the legal operators just scored their biggest regulatory victory in years, and this is easily the most exciting update in the report. Let's do a callback to our Q2 2026 deep dive. We spent a lot of time back then analyzing the absolute ban on lottery outlets in the state of Kedah.
We did.
Local state governments were literally refusing to renew the operating licenses for these physical storefronts.
And it was an existential threat, really. If municipal governments could arbitrarily shut down retail outlets, the entire physical moat of the business was at risk of a slow, agonizing death by 1,000 cuts.
Well, the resolution is finally here. On August 12, 2026, the federal court unanimously ruled that gaming licensing is strictly a federal jurisdiction. State governments cannot override it.
The permanence of this ruling really cannot be overstated. This is not a temporary injunction or a lower court delay. It is a landmark precedent from the highest court in the land.
Massive.
Yeah, it means the federal government has absolute authority, which paves the way for SPToto to officially reopen 19 closed outlets in Kedah.
19 physical stores coming back online. That is real, tangible revenue returning directly to the balance sheet.
Analysts are projecting this will provide a durable revenue inflection starting immediately in FY27. Because of this legal victory, their regulatory moat score actually bumps up to a very strong 8 out of 10. They now have an ironclad federal shield protecting their nationwide retail footprint from local political disruption.
Okay, so what does this all actually mean for the stock price today? Because the market has to price in a bleeding UK dealership, a massively profitable lottery engine that just had a great Q4, a 76% dividend payout ratio, and a historic Supreme Court victory. How on earth do you value a machine this complicated?
The market is definitely struggling to price it. So as of August 26, 2026, the stock is trading around RM 1.37. If you look at standard analyst coverage like Hong Leong Investment Bank, they maintain a hold call with a target of RM 1.35.
Okay, so barely moving.
Right. They acknowledge it offers a very attractive 7.6% projected dividend yield for FY27, but they remain cautious. They want to see proof that HR Owen can actually stop losing money before they upgrade the stock.
So that's the standard conservative view. You just hold it for the 7.6% yield and you wait. But what about the intrinsic value? Like, what are the underlying parts of this business actually worth if we pull them apart?
So that requires looking at some of the parts, or SOTP valuation. And human psychology plays a huge role in investing here. Fund managers and markets, they hate messy, complicated narratives. They want pure play investments.
Right, simple stories.
Exactly. So when a company mixes a highly profitable lottery with a struggling foreign car dealership, the market punishes the entire stock. We call this a conglomerate discount.
So the market applies a penalty, basically, just because the business model is annoying to explain to an investment committee?
Essentially, yes. But the SOTP method strips away that discount. It values the cash-generating lottery business on its own merits, values the car dealership separately, and then subtracts the company's debt.
Okay.
And when you run that math, the intrinsic value of SPToto is roughly RM 1.80 per share.
RM 1.80. That is over a 31% upside from where it's sitting today at RM 1.37.
Exactly. The current RM 1.37 price tag means the market is pricing in the absolute worst-case scenario for the UK operations, while seemingly completely ignoring the massive federal court victory in Malaysia. Yeah, if those 19 PETA outlets successfully reopen and generate cash, and if the new Hatfield complex in the UK manages to stabilize and actually transition to that high-margin service model,
then the stock is heavily undervalued right now.
Yeah.
It presents a very compelling value proposition. If you are an investor willing to wait out the macroeconomic storm in the UK, you basically get paid a 7.6% yield just to sit there while management tries to fix the car business.
it's a classic deep value setup, provided the dividend remains intact.
So pulling this all together for you listening, why should you care about this specific financial update? Because SPToto is the ultimate high-yield defensive play wrapped in a deeply flawed package. Yes, you have to stomach a bleeding UK car business that requires patience and massive capital, but you are being paid an 11-cent dividend to wait.
And that dividend is funded by a highly defensive Malaysian lottery engine that just secured a historic legal victory to protect its nationwide retail moat.
Exactly. It's a business defined by stark contrasts. And there is one final, really provocative dynamic to consider before we go.
Right, the digital question.
Yeah. The federal court just secured their physical retail moat. But we know the illegal market is already a RM 9 billion digital shadow economy. What happens to SPToto's valuation if the government eventually realizes they are losing billions in tax revenue and decides to legalize online betting for the licensed NFOs?
Would that instantly double SPToto's addressable market overnight, or is the black market already too entrenched with better odds to be disrupted?
That is the ultimate multi-billion ringgit question. Just imagine taking that perfectly legal money printing machine in your basement and suddenly being allowed to plug it into the internet. The entire dynamic of the company would change instantly.
It really would.
Well, thank you so much for joining us on this deep dive into Sports Toto Baran. We always love unpacking these complex hybrid businesses with you. Please take a second to like, subscribe wherever you listen to our deep dives, and comment below with your own thoughts. Does a 7.6% dividend yield make it worth weathering the risks of a bleeding UK car dealership and a massive shadow market? We really want to hear your take. Until next time, keep diving deep.